Thank you all for being here. I say this every year, but I love meeting everybody in person. It is so great to get out from behind the screen names and just see faces. And this event really energizes me every year. Today I want to talk to everyone about two things I get questions about quite a bit. Tracking setups, which I think is a big edge for me, and also trading psychology tips, because I think the mental side of trading is one of the biggest challenges. Before I get into that, there is one thing I need to talk to everyone about, and that is a person that I call Nigerian Tim Grittani. And I call him that because someone sent me a screenshot of a Facebook Messenger conversation where they were talking to an account named Tim Grittani, and it had my photo, and the location was Nigeria. And this has been a big problem in the trading community lately, where there is a scammer or scammers who are making fake accounts of myself, Tim Sykes, Ducks, other big traders, and they are reaching out to people trying to scam them out of money, saying you could either wire me money and I'll trade your account for you and I promise you X returns, or I'll mentor you, and for mentoring you, just send me this money. And a lot of the times, the key tip-off word here is they say, send it to my Bitcoin wallet, which none of us will ever say. So I just want to tell everybody, be really careful who you're talking to. I don't do any private social media messaging at all. I mean, this happens on Facebook, Instagram, Twitter. I don't do any of that. I can't speak for Ducks or Sykes or the other big traders, but I can tell you that none of us will ever say, send us a private wire transfer for any reason. If you are interested in our services, our products, any of that, go to our main websites, but don't ever send Bitcoin or a wire transfer to someone's personal account. I just really want to make sure that nobody else gets scammed by that. So now that that is out of the way, I will get into tracking setups first. And tracking setups, let me just start from square one. What do I think about when I want to track a new setup? The first thing I need very clear criteria. What does the stock have to do to qualify under, a specific setup? And I have names for my setups: overextended gap down, multi-day breakout, parabolic short. All of those things have their own sets of very specific criteria. And I decided it would be a good exercise to start tracking something that I've heard about pretty much my entire trading career that I'd never really put numbers to before. The idea that if a stock has a big, strong first green day, it's likely to gap up the second day. I've never really looked in depth into that, and I was curious, what are the odds that you get that gap up? What are the odds that you'll be profitable? So let's talk about the criteria that I put out for that. And these are just my criteria. These aren't right or wrong criteria, they're just what I settled on. So I only wanted to do it for listed stocks. There's differences between listed and OTC stocks, and I just decided that listed stocks were what I wanted to track for this example. It had to be day one of the move. That's what I'm tracking. I don't really want to look at day 2, day 3, day 4, because the further into the run it is, that probably changes the odds of whether it gaps or not. So for now, just day 1. I want it to be very volatile, so I set just 50%. Just kind of randomly picked that number. I want it to be up 50% or more on the day. And I want higher than normal volume. That one, I don't have a strict criteria, not like 10 times or 20 times normal, nothing like that. It's just kind of, I look at a daily chart and I make a judgment call. Same thing for closing near the high of the day. I don't have a firm number for what near high of the day means. If I was forced to say something, I would say I want the daily candle to have closed in the upper 2/3 of the day's range. And then also under $15, because that's just the price range I'm more comfortable with. So this chart here on the right is a pretty good example of what a good day 1 might look like. And the question was simple. What if I started buying these right at the close and sold right at the open the next day? Whether it gapped up or down, I'm in right at the close, I'm out right at the open. What would the results look like? And this is a picture of the tracker. Just very basic information. This is kind of bare bones for me. I've gone far more in depth on other setups. But just the date, the ticker, the day of the day 1, where did it open, what was its high, what was its low, what was its close, how much was it up on the day. And then the next day, open, high, low, close. And then I run some formulas over on the right there to get some ideas of either odds of the gap up or average returns in certain situations. Now, in this specific case, here are the results. At the time I tracked 44 samples when I made this slide. It's actually up to 47 now. And I'll just say the current odds because I remember this. I've got 47 samples, 19 wins, 28 losses. So that's about a 40 or a 41% success rate. Now, that's interesting. It's less than a coin flip chance. So let me just ask everybody really quick. Let me see a show of hands here. How many of you would take this trade? 40% chance of working. How many of you would stay far away? How many of you need more information? There we go. That's awesome. You guys did well. Yeah, more information I think is the correct answer because there's the other side of the trade, risk reward. So here are some more results. So like I said, it wins 40 or 41% of the time. Now, here's where the risk reward comes into play. Let's take those 18 or 19 winners I mentioned. If you had taken the trade and gotten out for a win, in the cases where it did gap up, your average return on those trades is plus 29%. If it had been one where it didn't work, one of those 60% that didn't work, and you're selling for a loss the next morning right at the open, your average loss is minus 13%. That's about a 2.2 to 1 risk reward. So risk reward is on your side, even though it's less than a coin flip chance. So you take all of those trades, you add them together, all of the wins, all the losses across 47 samples. The overall average return on every single one of those trades, it says 4.2% here, but given the extra few I tracked this week, it's actually more like 5% now. So average return over 47 trades, 5% gain, that is actually over 200% potential return. Now this assumes that you trade the exact same dollar amount on every single of those trades. So you can't play one huge and the other small because that's going to kind of skew which way your gains go depending on whether you were large on the losers or not. But this really is a setup that you might be surprised to hear, even though it has these overall favorable numbers, I stay away from. I haven't really traded this yet, and you might be wondering why. And this goes into trading psychology a little bit for me. It's hard for me to be in a setup where I only win 40% of the time. Even if I know that long-term I'm going to come out ahead, I've kind of conditioned myself to really value consistency and have more wins than losses. For me, that helps me trade with high confidence, and it's just who I am. Everyone's different. I'm not saying stay away from this setup. It could be something that you can keep a scope on the big picture and you can handle psychologically. I just don't think I can, and I think it's a mental trap for me. So I've avoided it so far. Just one other thing I want to say about these results is that, of course, this is past data. Past data doesn't always predict future results. The larger my sample size gets, the more confidence I'll have in it. Just to put this in perspective, I've been tracking these since about mid-May. So since mid-May, I've had 47 examples that fit all of my criteria. So just to go a little more in depth on what I track and how I track, I really have trouble telling people this, but there is no right or wrong way. It all depends on the question that you want to answer and the data that will help you answer that question. In this very basic example here, I was saying that I was only looking at just open, high, low, close for each of the 2 days, and that was about it. Now, it's still possible for me to refine this further. This is just step one of my journey, usually, when I go into a spreadsheet. There are a lot of tweaks I could make now. I could change my threshold on percent gain. I could look and see if the ones that are up 75% on the day or 100% on the day, if those tend to perform better. I could track additional information. I could take the float of every single one of those stocks and see if there's any correlation between the lower the float, the more likely it gaps up. So you can always add more information. I've always liked to just cast a wide net at first, though. I cast the wide net, I go from there, and then I start to try to narrow it down and find ways to cut out some of those losers and make it more consistent. One obstacle that a lot of people have is they say, I don't really understand Excel. I don't know how to do the formulas. And my answer to that is take an online Excel class, because you can do that for very cheap. I recently discovered Udemy, I'm still not totally clear on how to say it, but that's a website that has courses that span thousands of topics, and they're pretty good courses. You can see how well they're reviewed, and even if they're listed at 100 or 150 bucks, like no joke, they have a different sale every single week. Like I can't remember the last time I've bought a course for more than $12. So it's a very affordable, very easy way to educate yourself on something that could really help give you an edge in the market going forward. Spreadsheet tracking has been huge to my success. An example I love to give of this is back when I was first getting started trading. And one of the setups that I gravitated towards was multi-day breakouts. And multi-day breakouts, I had been watching all the video lessons, the DVDs, and had the phrase drilled into my mind, resistance becomes support. So, for example, if I'm watching a stock break past $1 on a multi-day chart, it's a breakout, I expect that dollar level to hold perfectly. I think, hey, resistance becomes support. So I start trying to trade breakouts with this mentality, and a lot of times what I noticed happening was the stock would dip back under that dollar mark. I'd stop out at 98 cents, 97 cents. I'd say, oh, this is failing. Support didn't hold perfectly. And then an hour later, the stock's at $1.20. And I say, man, I got faked out. How did this happen? Like, this was just a really tricky breakout. So I started tracking them. I took the extra time on my own, and I put them all into a spreadsheet, and I started to see the pattern emerge on paper, which really helps me, that it was not at all uncommon for support to not perfectly hold. In many of these cases, you would see the stock shake out just below the breakout level and then continue on as if nothing had happened. And yeah, there were a few breakouts that just didn't work, but I was able to see that too and prepare myself to set better risk levels. And I was off and running. That was a big part of what helped jumpstart my growth. I got to see the difference between perception and reality, how I thought things should be versus how they really were. And that helped me start playing my breakouts with smarter risk. Sure, I didn't win on every breakout, but I became far more consistent with the setup, and it was a huge driving force in my growth. So I'm going to move on to trading psychology now, because a number that has just always astounded me is that 90 to 95% of traders lose. And that baffles me, because trading should be a coin flip thing, right? Like, if you're looking at it just statistically, you enter a trade, you either win or you lose, and you do it over and over. Like, that should come out to about 50% long run. So how is it that 90 to 95% blow up? What causes that? I don't think it's that the patterns are too hard. I really don't. Sure, at first, you're still learning. It takes time to recognize it, but that gets easier over time. And yet, we still have this huge blow-up rate. The markets may be a bit rigged. There definitely is a lot of manipulation. I'm not going to get too in-depth onto that, but despite that manipulation, I actually think that helps my odds. I think that helps make the moves a little more predictable. You kind of get a feel for how the manipulation works, and you try to play along with it. And also, it's not all BS and paper traders. I mean, there are successful day traders out there. So it's not just a bunch of people faking it. So why is it that so many fail? I am convinced it is the mental side and the psychological side. And no matter where you are in your journey, that never goes away. You are always going to struggle with the psychological side of trading. Yes, the patterns become easier. Yes, trading overall can become a bit easier, take a little bit less work outside of market hours. But you will never stop having the internal battles, and keeping yourself in check is the most important thing you can do. So what I'm going to talk to you about the rest of this speech is I'm going to go through a lot of psychological mistakes that I've had to deal with throughout my career, ways that I've dealt with them, and I'm just going to start off with a few that are kind of geared towards beginners that I especially remember when I was starting out. So the first one is the follow the leader approach. I signed up to penny stocking silver when I first started, and I wanted to learn. I wasn't just looking for quick bucks, but on the side, I definitely wanted to follow whatever Tim was doing. I went as far, when I was still studying and hadn't traded yet, I went as far as to track all of Tim's long trades in an Excel, see what % he had made or lost on those long trades, and try to project it to my $1,000 account and be like, okay, if I just gone all in every single pick of Tim's, here's the gains I could have expected. And so I can make some quick money and I can learn at the same time. That'll be great. I think that, hey, Tim is the pro here, I'm the newbie, he knows what's up, I should just follow him. And the reality of that situation was I could never match prices. The penny stocks moved too fast. I'm not the only genius with that idea, and you usually have a bit of an effect of a lot of people trying to just blindly chase, and that pushes the alert up way too fast. Also, if you're in the trade waiting for that sell alert and you have no idea what to do on your own, you feel totally lost. There were a number of times where I'd be in the trade super scared, just waiting, is Tim going to sell? Is Tim going to sell? And even when Tim did sell, it takes time for him to type out that sell alert and talk about his reasoning behind the trade. And again, there can be a lot of price movement in that time between when Tim sells and when the alert hits. So I never can match prices, and this was just a way that you could slowly bleed away your account. I really think that's the main impact of trying to follow the leader. The other side of it too is that you don't learn to think for yourself. The idea of trade alerts is to learn the thinking behind the trade. What pattern are they seeing? That's the question you want to answer. And how can I learn that pattern myself? But blindly following just doesn't work. So, solutions for this. Getting the discipline and the recognition of this situation so that you never follow the alerts. You just try to learn from them instead. Another big problem for me as a beginner, fear of losing. I get questions about this one a lot in webinars. People who, they feel like they can see the pattern decently, and they're just afraid to pull the trigger. And believe me, I was there too. I would get so psyched out entering a trade. We're talking like I would be shaking. My heart would be racing. Like I was like, oh my God, am I having a cardiac event? Like it was scary. It was really scary when I was first starting out. And that is the one side of a potential impact of being afraid to lose, that you just are going to miss a lot of trades because it's just a really scary idea. The other potential impact is that you can get yourself to take the trade, but if it's not going your way, you just won't cut that loss because you don't want to lose. You want to wait for that stock to come back in your favor. It's going to be okay eventually, you tell yourself. You just try to rationalize some way that you could get bailed out of this trade. So what causes this fear? I think it's a couple of different things. One is that you just have a really small account and you can't afford to lose. I think that this also ties into maybe how much money you have saved up other than what's in your account. And I really like to tell people that you've got to wait until you have enough money in your accounts that you don't have to be afraid for this reason. I always believe you should trade small when you're first starting. But if you are trading small and you're still scared because you just can't afford to take the loss, you're going to be fighting an uphill battle the whole way, and you're going to have a really hard time making rational decisions. So I think that the best course of action is take that time to study, to learn patterns, still make the time useful, but wait to actually put your hard-earned money on the line until you are rid of a major psychological hurdle and you have a little bit more to fall back on. The other thing that I think causes it, which is a little bit irrational, and I think I fell more into this camp, was just kind of being prideful, being afraid of being wrong. I knew that I was good at cutting losses early in my career. I knew that I really wouldn't take any major catastrophic loss, so that wasn't where my fear was coming from. And just for whatever reason, and that's just who I was just afraid of being wrong. Like I had a lot of self-worth and pride tied up in making a winning trade. I would feel like a failure if I didn't. And I wish that I had like a quick fix for that, but really it just took time. You got to recognize that it's kind of irrational. Every trader is going to lose. I don't have a slide for it this year, but the past couple speeches I've done, I would have had my profit chart up there and my win percentage. And in the last 3 or 4 years, every year my win percentage drops a little bit. I think it went from 70% to 69% to 68%. So I mean, I'm probably trading at about a 60 to 65% success rate over the past few years. And I'm still very profitable, but cutting losses is a must. It is a huge part of trading because that way you don't put yourself in a blow-up situation. So, I mean, just try not to be afraid of being wrong. You have to accept that you will lose sometimes. And if you're trading small size, there's nothing to be scared of. Just give it some time. Keep kind of forcing yourself to take these trades with your small size. And that issue, it does eventually resolve itself. It got easier for me with time, and that was the main factor. One last beginner thing is getting rich quick. A lot of people come in and they want to be millionaires tomorrow. and this is a marathon, not a sprint. What causes this is kind of the overconfidence from how easy that video lessons can make trading look. And also, what can quickly decimate your account is if you take this overconfidence and it translates over into trying to trade really big. I really cringe when I have the new students talking about the large accounts they're trading, and I'm thinking to myself, you're only a month into this. Like, don't trade money that will be really hard to recover in terms of real-world money. It was such a big deal for me that my first blow-up was only $1,500 because I worked a summer job at State Farm. I made $4,000 that summer. So in terms of real-world money, that $1,500 was no problem to try again. Now, if I had been trading $10,000 or $20,000, that would be a totally different story. I don't think I'd be up here today. So no matter how confident you feel, no matter how much you think you know early on, you're going to face things in the market that you haven't seen before. We have these plays every year that I like to call the black swan events, where you might see a pattern that works 99 out of 100 times, but then the one time out of 100 it doesn't work, it just decimates people. Usually short sellers. Usually it's the short sellers who get in trouble on those. But yeah, the first time you face a black swan event, you don't want that to be ending your account. And you don't want it to be a huge account, especially if it does. So early on, you have to assume you know less than you think you do. And you have to trade small. Those, I think, are the two big fixes to just put everything in perspective. And again, just remember, it is a marathon, not a sprint. So now, some other more general things that I think I would say I've struggled with my entire career. And this is a big one, FOMO, which stands for fear of missing out. So some impacts that you might face if you are trading with FOMO. You're trying to trade everything. You're trying to trade outside of your niche. Setups you're not that comfortable with. You just want a piece of the action. You're forcing stuff you don't understand. And you're going to get terrible entries as a result. You're going to get really bad results as a result. Because if you're trading things that aren't your niche, you're going to get really, really random results. What causes that? I think a big part of it is social media and the chat room culture. It is very difficult to be exposed to that every single day. And maybe you have one or two setups that you are very comfortable with, very good at, and those setups just aren't there on any given market day. So you're having a slow day, you're in the chat room, or you're on Twitter, and then you see someone posting about a big gain they made. Or on some random big runner, some people are saying, hey, I'm long this runner, this is great, it's going straight up. And you start to get that itch. You're like, man, I'm sitting here having the most boring day in the world, and I'm watching other people bank. And that's so hard to tune out. You kind of start feeling like I should be doing something too. And before you know it, you're in that random trade. You chased an entry. I have certainly been there. Just takes time, but you've got to learn to ignore that noise. It was difficult for me. My big turnaround after my blow-up was that I cut out a lot of setups. I was focusing on my niche. I was trying to only buy new promotions, only buy multi-day breakouts. And I would go through those days. I would go 2 or 3 days in a row without making a trade because my setup just wasn't there. And I'm telling you, it's not easy to block that out, seeing other people in the chat room making money and feeling like you're missing an opportunity. But the most important thing in trading is focusing on yourself. That's not what you're trying to do. You're not trying to nail that setup. You're trying to focus on the two that you're good at, the two that you're consistent at. That's your goal. So there's absolutely nothing wrong with missing something. There are so many different sectors in the market. There's so many different types of stocks you can trade. There's no way you can do it all. Every single successful trader I know does things differently. So don't try to be somebody else. Don't try to bank on a ticker just because somebody else is banking on that ticker. You need to focus on where you're good, and you need to stick to it. Self-comparison. This goes along with what I just talked about a little bit. Early in my career, when I was starting to get consistent, I was starting to get good, I would have a nice day. You know, for me at the time, a nice day was $200, $300. And I'd feel good about myself. I would go onto Twitter at the end of the day, and I would see a couple of the top traders posting that they made $3,000 or $5,000. And sometimes it would be on the same tickers as me. And it's really hard not to look at that and feel like you should have done more or feel inadequate. And I mean, again, it goes back to you have to just focus on yourself. where you are in your journey. I don't want to focus on how I profited compared to Ducks, who always trades 10 times the size I do. I want to focus on how I profited compared to the last time I tried to play that setup, or the last few times I tried to play that setup. You're looking for self-growth. You're not looking for how you compare to others. Everybody's journey is different. You're not going to have the same learning curve as somebody else. You're not going to be profitable at the same rate as somebody else. And I know that we want a benchmark. We want something to compare ourselves to tell us how we're doing. But that's not realistic in trading. Everybody is so different, and everybody really trades with their own personality. So all you can do is just try to take a step forward every week. I wouldn't even say every day, because different days have different opportunities. It's hard to look at it on that small of a scale. I've always thought in terms of weeks. And not even so much that I want every week to be more profitable than the week before, but just that I want to come out of a week and look at that week as a whole and feel like I made fewer mistakes than last week. Or, the setups that I had this week to take advantage of, no matter how many or how few, I want to feel like I traded them well. So it is self-reflection you need to go for. And again, be happy for the other traders who post the big gains, sure. But don't hold yourself to that standard. Just take one step forward every week in your own journey, and you'll get there before you know it. Boredom trading. I go through this one a lot too. You'll notice I'm saying, I haven't solved a lot of these. I can tell you what'll help, but I'm still far from perfect. And boredom trading, potential impact is pretty obvious, but you force dumb trades. You do something just because you're looking for a little bit of action. What causes it is slow market conditions, or just chasing productivity is what I like to say. It's hard to sit at a computer all day. You feel like you should be making money. You feel like you should be doing something, and if you're not, it's hard to feel like you're being productive. You feel like it's a wasted day. But don't underestimate the value of that screen time. The days early in my career where I would go 2 or 3 in a row without making a trade, I was still in front of it. I still made myself watch some of these tickers and how they acted and how they performed at certain points in the pattern, and that's valuable. It's valuable just to sit there and watch. So no, you're not wasting a day. You're not wasting time. Sometimes the best thing you can do is not make a trade. And I think it gets a little bit harder even when you get later into your trading career and you get a little bit more of an ego, because you get used to making a certain amount of money, and when those slow weeks come around, you say, whoa, what happened? I'm not that profitable this week. And then you really want to make something happen. That's the mental trap I fall into lately, at least. And it always turns into, instead of taking my A+ setups or my B setups, I really take a C or a D setup, something I don't trade that often, that I'm not that comfortable with. And I just sort of grab it and say, okay, I hope this works out. And I would say overall on those trades, I definitely am in the red. So potential solutions for that, self-reflection. You've just got to look inwards and ask yourself, why am I taking this trade? And really get to the root of it. You've got to be very disciplined. And again, it's not easy, but it takes a long time and a lot of work, but you can start to recognize it. You also have to have realistic expectations. You can't expect to make the same amount of money every day, every week, every month. The market is going to have its ups and downs. We have times where the market is absolutely insane and I have more plays than I can handle. We have times where I want to just go back to bed. I have really struggled the last couple of months because of overtrading specifically, I think. The weed stocks have been going kind of crazy, but in all the other sectors in small cap land, there haven't been too many parabolic runners. And that has led to me taking a lot of boredom trades in the weed stocks and chewing myself up. Since the start of August, I've felt like I haven't traded well. And this is to blame. One thing I could have done that I wish I had done is just left the computer. Even if it is that early point in your career and you do want that screen time, if you're having trouble with the discipline of not pushing buttons, just walk away. Go do something fun for a couple hours. I mean, midday lull. We all have heard about the midday lull. There's nothing wrong with going out and just getting lunch. So give yourself a chance to separate from it. These are the little things I think can help. Swinging for the fences, wanting the big home run trade. This could lead to horrible, horrible losses. Or it could lead to a situation where you enter a good trade, you got a nice winner, and you just get greedy. You want more. You want it to be a huge win. And next thing you know, that win is a loss. And that is a psychological gut punch. Also, just inconsistency. If you're trying to hit a home run every trade, you're probably going to hit a home run here and there, but you're going to lose on the vast majority of the rest of your trades. So the mental causes of this, chasing the big win. And that usually happens to me during the times of boredom trading, actually, where there's not much going on in the market. I'm having a slow week, and I just want a big win to pull myself out of that slow week. Also, I think early in your career, it could be it could be you trying to grow your account fast. And again, can't rush it. Marathon, not a sprint. I did not get to where I am by having a few big winners here and there. I got here through consistency, lots of singles. The singles add up. I remember specifically playing the new promotions, and the new promotions that helped grow my account, I would say about 75–80% of them would run for multiple days. And they would go 200, 300, 400%, something ridiculous and wild like that. I was always out in 10 minutes. I would buy right upon announcement, I would sell into the predictable spike, and that was it for me. And those added up fast. And sometimes I would feel bad that, yeah, oh, I sold this stock at 20 cents and it went to $1 2 weeks later. But then there would be the other plays, the ones where they announce the new promotion, it goes up about 20, 30% in the first 10 minutes, and then by the end of the day, it's down 80%. And they totally just sold into it and crushed it. I avoided all of those. There were some major promotion traps I saw during my first year of trading. And I never got burned by a single one because I valued consistency over the home run. I wanted to just be consistent, gain confidence, make a profit. That's what mattered. I didn't need to hit a grand slam every day. I just needed to be consistently profitable because that was my goal. I wanted to be self-sufficient. I wanted to be able to be out on my own. I just wanted to make a decent living from trading. I wasn't trying to hit a home run every day and be a millionaire as fast as possible. That honestly was never a goal of mine from the start. Revenge trading. I go through this one from time to time also. This especially happened to me after my Lake loss, $290,000, where you just take a gut punch of a loss. Everyone's going to go through that. I mean, there's no avoiding it in your career. You're going to take some losses that really hurt, and it throws you for a loop mentally, and you just want to make that back. You feel so bad. And so for Lake, what happened to me was I started trading the other setups after Lake had played out that I was seeing, and I was trading them with about 5 times my normal size. I was really going after it because I was like, I'm just gonna smash this trade and undo this damage as quickly as I possibly can. And I think the first trade I made after my $290,000 loss with that really big size, I think I made about $60,000, and then I made another one like that, and I lost about 70 or 75. And I mean, Lake was my worst loss at $290,000. I think that $70,000 or $75,000 loss was definitely a top 5 or top 10 loss at that point in my career, and it happened within a few days. And it was just because I was pushing. I was not trading like myself, and I don't necessarily think that every time immediately after a big loss you would fall into revenge. For me, it's more after the play is over. So I have no problem now at this point in my career of taking some big losses on the way up of a parabolic short. If as long as I'm cutting them, I'd just be playing larger size than normal. But if the tank day comes and goes and I miss that main play that I'm waiting for, that's when I would slip into the revenge trading. That's when I would say, wow, the play's over, I totally screwed it up, I gotta get this back. So there's a certain amount of time I can keep my head in the game, but if I blow it at the end of the play, then I totally fall into this. So the solution, I mean, again, you should be really self-aware of what you're doing. You notice I'm repeating that a lot, but it's just so important. You really have to be in tune with your inner self and figuring out what's going on in your own head. But a lot of times that doesn't help me with this one. This is one of the most gut punch things for me as a trader. So I have to take time off. I have to walk away. And usually it's a week, 2 weeks, something like that, and it always helps. Every single time I just get that time to calm down and relax and have some time away from the market, and I come back and I'm no longer in revenge mode. You know, if you play poker, you would compare it to going on tilt. You just need some time away, and then once you get back, you're back to your rational state of mind, and you just get back to doing what worked for you before. You've had time to reflect on the mistake, you've had time to figure out how to fix it, and just get back to business as usual and try not to repeat that mistake again. Addiction. This is one that I definitely struggle with. Trading is very, very addictive. And the impacts of addicted trading, definitely over trading, because you just want that adrenaline rush. And also you just miss out on life. This has been something I've been reflecting on a lot lately, because I spend Monday to Friday in front of my screen from about 8 to 5 every day. And then I'm checking my phone after hours. I feel like I can't tear myself away from it. And especially at this point in my career, I don't like that. I want to be able to separate a little bit more. I want to be able to take a more passive approach to the markets, maybe find a few more longer-term setups. And what causes it for me, again, is I love the adrenaline rush. And you want to be productive. You want to feel like you're in front of the screen doing all you can to be successful at trading. And also FOMO. That's a big problem for me too with this, is if it's a slow day, it's midday, and it might be time to walk away, I'm afraid, what if there's a play while I'm down at the pool or while I'm away at lunch? I'm so scared of missing something. And some solutions for this are you just have to force yourself away. If you notice yourself over trading every single day, recognize that pattern within yourself. Force yourself to step away from the screen. Also, if you have friends, family, or a significant other who can drag you away, that is even better. My wife Donna watches me trade a lot. She's around every day, and she's developed a sixth sense for this kind of stuff. I can't tell you how many mornings Donna has said to me, "I don't think you should trade today." And I say, "Oh, you don't know what you're talking about." And then I lose money. It happens almost every single time. So I really do need to learn to listen to her. But I mean, when we were down in Puerto Rico together, those midday lulls where we would go down to the pool together, just get some time away from the screen, so helpful, just so helpful. So if you're not gaining anything from that screen time of watching the pattern, just pull yourself away for a little bit. It's okay. You don't have to be productive 24/7. You just don't want to be in a position where you are forcing things, because you will chew yourself up. Distracted trading. This is one that I experienced for the first time last year. And the potential impact of distracted trading is big losses. And what causes distracted trading is negative life events, things outside of the market beyond your control. For some people, it could be the death of a loved one. It could be, someone is sick. Could be some kind of natural disaster, and that's what it was for me. It was around this time last year when Hurricane Maria hit Puerto Rico. And I knew that the condo that we lived in was going to probably be in very bad shape after that. It was like a total communications blackout out of Puerto Rico for the couple of months, or a couple of weeks following that. And I just kind of threw myself into the market. I really just wanted to distract myself from that negative thing going on and have something to feel good about. And September had gotten off to a decent start of a month, and I had just, for whatever reason, decided, this is the month that I think I'll size up, I'll trade bigger, and I want to try to have my best month ever. Because I'm already off to a good start. I haven't had my best month in a really long time. This is a good time for it. Let's do it. So I started pushing my size. And again, I'm just trying to distract myself from all these negative feelings about the stuff going on outside of the market. And I took a string of losses. I took about a $100,000 loss on Himini. I remember talking about that one at the conference last year up here when it was down at like $4. And I took a much larger short than normal on it. I think I shorted it at about 7. And I wound up cutting it at 10, lost about 100K. And I had a lot of other trades like that too. I think MNKD was another one where it had a day where it gapped up big or something, and I threw a ton of size at it short, and it stopped me out, and I lost 30 or 40K there. And I did this on about 3 or 4 different tickers where I just decimated myself. And September was one of my worst months in a long, long time, in fact. I gave back all of my beginning of the month gains and then some. And it was just because I was searching for something to feel good about, and I was really in no state of mind to trade. I've heard about this with other traders too. I know it's not just me. I've heard of people who, find out that they've got a sick kid or something like that, and just get absolutely destroyed in the ensuing month or two. So if you can't come to the market with a clear state of mind, if you're looking for the market to fix how you feel about something, you shouldn't be there at all. It's okay to step away during those times. Again, I know you want to feel productive. I know you feel like you should be in front of it. This is supposed to be your job. But if you're just going to do more damage than good, don't be there. Main issue, stubbornness. Took me a long, long time to work through this one. Potential impacts, big losses, and a trading career. And what causes it? Not wanting to admit defeat, or your current loss just feels big. What I mean by this is sometimes we sort of accidentally find ourselves in a situation where maybe we sized into something a little too big, and it hits the point of our stop loss, and we know that, hey, it's time to get out of this. Like, the chart is not right. But you look at that number of how much you'll be down if you close that trade, and that just does not sound good to you. And a switch just kind of flips in your mind, where you say, you know what, I'm just going to wait for the market to hopefully fix this. Maybe I'll get a, for me it happens a lot when I'm short, so I say maybe I'll get a pullback I can cover into and lessen the damage. But yeah, it's just that switch flip moment where, maybe $5,000 loss feels bad, and you're like, well, 10,000 is going to feel just as bad, so why not just give this a chance to work out? Also, I hear the excuse a lot, I got stuck. There's only one time you maybe would get stuck, and that's if you're in something overnight and they release surprise news. There's not a lot you can do in that situation. That might happen from time to time. But getting stuck is not, my stop loss has come and gone, I've chosen not to cover, and now I'm down a lot and I just don't want to. You always have the choice to push that button. You always have the choice to get out. Like I said, I went through this for a long time. I took my $290,000 loss on Lake because of stubbornness and because of fighting it and trying to fix it. And that loss sucked. And I said to myself, okay, well, I just took that loss, I've learned my lesson, that'll never happen again. And 6 months later, I lost $180,000 on PBMD. And I said, okay, well, I'm a little surprised this happened again, but I've got it this time, won't happen again. And 3 months later, I lost $105,000 on CANF. And every time it was the same mistakes. I would get stubborn, and then I would fight. And here's how I dug myself out of that mental hole. This was not a one-day fix. Even 3 six-figure losses couldn't fix this for me. So how did I fix it? I held myself accountable. I made a spreadsheet. After reading a trading psychology book, 101, or what is it, Trading in the Zone? Yeah, I'm blanking on it. Daily Trading Coach, that's it, Daily Trading Coach, 101 Lessons to Being Your Own Trading Psychologist. That's the book I read. Brett Steenbarger, very, very good read. And it gave me the idea for this spreadsheet to track my losses. Not every single time I lost, but every single time I made a mistake. And I forced myself to size way down, to sizes that were smaller than anything I had traded in a couple of years. And that was not easy. It was hard to see some prime setups and playing with what felt like puny size, but I knew I had to fix my discipline. So every month, I would go through the month, I would tally my mistakes, and at the end of the month, if I felt like I did a good job, I could increase my size a little bit the next month. If I felt like I did a bad job, my size had to stay the same or go back down. This was about a 10 or 11 month process for me. And if any of you have seen this on my YouTube channel, you would just search Tim Grittani to find my channel. I chronicled these months. At the end of every month, I would do a recap of my month, the mistakes I had made, how I felt like I performed, how I felt like I could do better. And like I said, this was not a one-day fix. This was months of work. But eventually, I got my size back to where it had used to be, even larger. And I had completely killed the stubbornness bug in my system. I broke the bad habit. Now, yes, I still take large losses sometimes, and that's really more due to the mistake if I trade something too large. TLRY gave me fits over the last 2 weeks. I probably took about 6 or 7 $30,000 losses on that stock. It chewed me up good. But the key on that one was, as bad as those losses felt, every single time my stop hit, I was out. I never went on the ride. And that thing went to $300. I was trying to short it as early as 80. Can you imagine if I had about an $800,000 or $900,000 position on that at $80 and I rode that to 300? That would have been, a mind-blowing record loss. So thank God I don't get stubborn anymore. And if you struggle with that, I really recommend doing something to hold yourself accountable. Maybe it's tracking in a spreadsheet like I did, I don't know, but be ready for a long journey and really, really having to work towards it, because this is the main thing that takes out traders. It could be a beginner trader, it could be a veteran trader. I've seen all levels of trader get hit by this. And again, it just takes that one play out of 100, the really rare one, the thing you've never seen before, where you didn't cut a loss and it destroyed you. Don't ever put yourself in that position. So some concluding thoughts on the psychology. The emotional side of trading, it never goes away. Some of these issues, they will get easier with time. But don't expect to wake up one day and say, oh, I've solved trading. This is the easiest thing in the world. Because that's not going to happen. That's not a realistic expectation. It's a daily battle. You have to look inwards. You have to hold yourself accountable. You have to reflect on why you're doing what you do. At the end of every day, just take 5 minutes. It doesn't have to be right after the market closes. It could be that night before bed. Think about your trades. Think about the actions you took. See if you can think about mistakes you made during the day. And again, not every loss is a mistake. A mistake is not cutting a loss. A mistake is playing too big. But sometimes setups just don't work. So don't kick yourself because you took a loss. Kick yourself because you made a mistake and try to fix it. If you hold yourself accountable, if you track this stuff in a spreadsheet, if you strive for better every month, I think you can slowly start to overcome these issues, or at least greatly improve them one by one. Thank you, guys.